Hit it.
It's Friday, October 7th, 2022, episode 197. I'm Patrick Seresna.
And I'm Kevin Muir. This week, we welcome back Paul Krake from View from the Peak. We have a delightfully entertaining discussion about opportunities in the climate markets and why Paul thinks the right tail risk for the stock market is woefully underappreciated. Then the crayon chewer himself, Patrick Seresna, is back to tell us what he sees ahead in these topsy-turvy markets and talking charts.
And then we end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on here. What beer am I drinking this week?
Patrick is drinking Flag Special Black beer from Bromley Brewery. It's so special I couldn't find any info on it online and also could not find any official picture. It's not even on their website.
That's hilarious. It came highly recommended when I was in Casablanca. And so I picked one up and I'm giving it a shot. And so far, actually, it's a really nice tasting beer on the first sip here.
Were you shocked to find there was gambling going on?
No.
No. Doesn't understand that, does he?
No, I don't.
You are in Morocco. And why don't you tell people what happened to your luggage?
Oh, no, I won't. Okay, so...
The reason that Patrick sounds like he's calling from a tin cup
is because I don't have an audio set, no headphones, because my luggage is gone anyway.
And Patrick tells me that he thought that they had lost it. I told them that it was likely getting sold on the side of the market, but maybe that was bad of me to say. Anyways, let's...
No. You're just speaking the truth, man. All right. Let's
go do the... before we go to the side effects, we have an announcement. It's a little bit of a sad development, but we hope that everyone understands. We taped this show on Friday night, and it's been a lot of work on top of our usual full-time weekday jobs. We appreciate everyone tuning in, as it's been a great experience for which we are extremely grateful. Now, don't worry, we're not stopping, but we have decided for the sake of our personal lives, we are changing the publishing schedule from every week to every second week. Nothing else will change. We've decided to leave the format exactly the same, except that it'll be 2 weeks in between huddles. Once again, thanks for everyone's support. We're thankful to each and every one of you. Thank you. All right, let me do the side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the gamma gunt, which when I saw that, I was scared to read it. Or it just didn't look right. Or the convexity cankles.
Oh, I hate when I get those.
Yeah. All right. On to the interview with Paul. It's our great pleasure to welcome back to the show Paul Krake from View from the Peak. Paul, thank you for joining us.
Kev, how are you? And more importantly, Kev, how was your lunch today, Kev?
So for those who don't realize, Paul actually sent me something before the taping today. It's more like dinner for me because we do this as the market closes. And all of a sudden at my door, I get a ring ding. And sure enough, there's a pizza. And it is pineapple and pepperoni pizza. And I guess you think this is the funniest thing ever.
Kev, I'm pretty convinced I'm not a very funny person, so yeah, it's probably one of the top 3 things I've ever done that's funny. But Kev, it goes back to a point that that you've emphasised a lot, sort of inadvertently, claiming that is it you or Patrick who claimed the Canadians invented apple pizza?
No, it's me, and I think we did. It was
right.
It was a Greek guy from Mississauga, I believe.
Got it.
Okay.
So that falls into the camp of the way that I treat sort of Australians and Italians. And I was lucky enough to be in Venice last weekend, Kev. I don't know what you were doing last weekend, but I was the missus and I were in Venice last weekend, and just how seriously the Italians take their coffee, which has a lot of similarities to Canadians and pineapple pizza, because the Italians don't grow coffee, and yet they believe they're the best at it. And Australians as well. Going to Australia drives me nuts because literally they take coffee so seriously, and I have no problem with like the dish soap coffee from the New York deli down the street, but they take it stuff very seriously. But I sort of believe that you can't claim global rights over something if you don't actually grow it.
Well, I don't think we claim global rights in terms of us making the best version of this. I think
Right.
we're just the only ones stupid enough to actually keep ordering it. And I do have a funny story to tell you. So it comes down to our house. There's a ding on the door, and I was like, "Oh wow, look at this! Someone sent us a pizza." And then we open it up, and it's pepperoni and pineapple. And my wife says, "Oh, what's that?" And I said, "Oh, I guess it's Paul sent it to me." And then my daughter says, "Well, why?" And my wife says, he must think it's funny that we eat this. And then my wife says, little does he know, the joke's on him. We'll love this pizza. And it's funny you mentioned coffee because Macro Alf is one of the fellows who always gives me a hard time about this because he's from somewhere in Italy that they take their pizza and their coffee very seriously.
Yep.
And so you've just basically insulted everything Italian and Macro Elf. You're probably never going to be invited on that show ever.
But I have a long and distinguished career of insulting people who I know and who I don't know. So the fact you said that is hardly surprising. But Kev, I do appreciate Kev's tone in this of our interview today because Kev, people are grumpy at the moment, aren't they?
Oh, it's terrible. We were just chatting a little bit before the show, and I was saying it is so miserable out there, and people are taking themselves way too seriously. And yes, I get it. We're in a bad bear market, stocks and bonds, terrible things. But, let's remember what's important in life. And let's just, I thought, what better guest to have than Paul that's an Australian who likes to laugh at things and to enjoy this time and to kind of perk people up.
And Kev, the thing I'm most proud of is the fact that I thought I was your 200th guest, which I got my numbers wrong. So I'm clearly the memorable 197th guest on the Market Huddle. So that I'm something to be very.
You'll always be at the top of the list in our hearts, Paul. That's all that matters. Okay, let's get into this. Let's talk about, for those who don't know, Paul has been on the show before, and we went through his career. He's been at tons of different places, whether it be Caxton, Goldman Sachs, Macquarie, a long career. Then he went off to write his own letter, which is called The View from the Peak. Terrific stuff. And we're going to talk about his market views. But one of the things I always like to do is to get some stories and to get his kind of unique perspective on the world and share his insights that he's learned over the years and decades. And Paul has been kind enough to recall a few. And I think we're going to start with a famous one with Soros and Tiger.
Yes. Kev, let's start with the obvious fact that I'm not getting a job at Goldman Sachs today.
Right.
I'm a white guy who speaks English poorly. Right, so I'm certainly not getting a job at Goldman Sachs in Asia, where I was blessed enough to look. The reason that I've had the luck that I've had stems from that, right? And that doesn't happen today. So for that, I was very lucky, and but getting to a firm like Goldman, when you're 24-year-old from Australia, who probably shouldn't, in the value of hindsight, probably shouldn't have been in the role. But it was this was during the Asian crisis, and this was from 94 through the Asian crisis. But the Asian crisis was as hectic as you could imagine, right? Because it was it's funny. So we were in recent times we've talked about this move to dollar yen back through 145, which was its highest level since the last intervention in Japan back in 1998. But for those kids who actually have not experienced intervention before, this intervention, Kev, we went from four big figures peak to trough?
Yeah, if that. Yeah.
And so over the course of 3 days, dollar yen during the last intervention went from 147 to 123 in 3 days. And the FX desk was equity floor where I was on was one floor below the FX desk, but there was a staircase between the two. So we would just go up to the FX desk just to see what was going on, and all hell was breaking loose, right? And on that, we were blessed at the time, Kev, to have at Goldman in Hong Kong. Mike Novogratz was running FX prop. Adam Levinson was there. on our equity desk, we had guys like Tim Throsby, whose last job was running the Barclays Investment Bank, Mike Daffy, who now works with Novo over at Galaxy, but was a very senior Goldman partner for many, many years. We had, it's really esteemed people. But up there as the intervention was going on, like literally, dollar yen was falling big figures at a time, right? And the most common, people were coming in from just getting stopped out of everything, right? And literally the most common thing you heard from the salespeople to the traders was, quote, "What's the fucking big figure?" Because literally, you'd make a price in dollar yen, it might be, let's say it's 145, and you'd say 30.40.
Yeah.
Right. But literally the price they were making was 140, 130, 146.40. Right? It was absolute utter mayhem. So at the end of the day, like, you'd take stock, and I was on the equity derivative desk, and literally you'd be trading just thousands of futures for Soros and for Tiger and for Tudor and for all of it. It was just absolute mayhem. And for a 24-year-old who probably shouldn't have been there, this was a pretty overwhelming experience. And this was back in the day where, at the end of the day, you had to send faxes.
Oh, yeah.
Right? And you would get your list of faxes to send out, and you'd give them to your assistant, you'd give them to the trading assistant to send out. And the only thing, there was a golden rule, and fair enough too, that if there was ever a problem with the faxes, it wasn't the trading assistant's fault. Right, not their fault, right? Yep. Because they're just doing your job for you, right? So anyway, I, in my esteemed wisdom, decided to send the Tiger fills to Soros, and the Soros fills to Tiger. To which Tiger was jovial about it, as in, "Don't worry about it. Can you just send the other ones?" Our friends at Soros were not as jovial, Kev. Not as jovial, as in, literally, it was the Spanish Inquisition. I was up, no exaggeration. Yeah, and it's the equivalent of saying, remember when you were in high school and you left your PE gear at home, and they'd ask you, why haven't you got your PE gear? And your excuse was you'd forgotten it, because that's what had happened, right? So when you send the wrong fax to someone, the answer to the question is why you did it is, I sent the wrong fax to someone. Right. But no, that's not good enough. And therefore, you need to have every person involved in the Soros account, Tokyo, Hong Kong, London, New York, on conference call after conference call after conference call, trying to work out why, or more importantly, how to cover their own asses in the event that these fax was sent incorrectly, where the only explanation at the end of it was, I sent the wrong fax.
Oh my gosh.
I remember getting to bed for the final call of about 9 calls at 4:30 in the morning.
Oh my goodness!
4:30 in the morning, because New York didn't give a shit, right? New York doesn't care what time you go to bed, right? And being back on the desk at 6, all because I sent the wrong fax to someone.
Oh gosh, I have a story that's very similar. In my day, when I started at RBC, I was hired to do the index trading. And so what I would do is we covered Wells Fargo, and Wells Fargo, which turned into Barclays, which was the biggest indexer at the time, would give us a list of stocks, and we'd go load them into the machine and then execute them market on close. But back then there was no market on close feature, so we would just bang away at the close. For kind of a couple of years we did this, and the good news was that money was always coming in. So there was never any selling, so no one ever got mad. Well, one year we get one quarter end or whatever it was, and I think it was a quarter end, and it was a big deal for the kind of clients on the other side. We get this big sell basket, and so we go, and it's like the TSX 300, which is the entire market. So we proceed to crush everything. Now, there's a very big famous account in Canada. I won't mention his name, but at the time he was the bee's knees and the one that everyone sucked up to, and he was convinced that someone knew his portfolio and had sold every stock in his portfolio. And it was the same deal. Everyone covering the account had to go up and see him and bow to him and say no, and explain to him. And it was just a huge hassle. And God, that's what happens when buy-side guys gets too powerful, eh?
I remember when we were at Goldman and we'd do trips to New York, right? Because so we'd go to New York, but so we'd be in the office during the day, and it was generally pretty relaxed. But we were on the trading desk, so we had to go and see the night traders, right?
Yeah.
So you'd get to their office, you'd go and see them at 10 o'clock at night, and literally you had orders of literally you'd go out to Brooklyn to go to Peter Luger's, and literally come back with steak dinners for like 5 different firms, right? And you'd be carrying these like boxes of steaks and sides around, like up and down 6th Avenue, delivering them to largely overweight night traders who, funnily enough, got to eat Peter Luger's 3 nights a week because guys like me would deliver it. And you'd literally be walking around and the next day your suits would smell like porterhouse, right? Because you're carrying boxes of this stuff around. And that was it. Look, and again, I worked nights when I first started at Moore. I worked nights, and literally the only saving grace to working nights is actually you can actually order a good meal because it's the most antisocial thing you'll ever do. But it's no, it was. Look, I mean, the whole night shift thing was. It's one of the best training grounds that people can ever have, right? Because you are structurally understaffed versus the day shift, right?
Oh, yes. So you have to do everything. You have to learn everything.
You have to learn everything, right?
Yeah.
So when I was at Goldman, and I was an equity derivative guy, right? So that was so I was Macquarie equity derivatives, and Goldman equity derivatives, right? But you get to the more capital desk, and you start trading Japanese basis, and you're trading, you trade FX, and you trade commodities for the first time, and it all gets to the most dreaded thing you could do on a night desk was JGB rolls.
Why is that?
Because it was the biggest contract. It was the biggest contract out there.
Yeah, it's still stupid big.
Big, and it was just prone to have massive errors.
Oh.
Prone to have massive errors, right? And I remember like I know of a desk that had a $3 million roll error once. So when you do your rolls, you were absolutely shitting yourself that you were getting this right, and literally you'd repeat the order 16 times because you were so nervous about doing it. But it's funny, just on something slightly more serious. I mean, I was chatting to someone recently about the quality of macro traders out there. And frankly, I do believe that the quality of macro trader has never been this poor. Right? I just don't think it's as good. And again, maybe it's me being nostalgic and having the honor of working for a guy like Bruce Kovner or Lewis Bacon and seeing guys like Paul Tudor Jones and do their thing. But I just don't think that the quality of macro investor is that good. And I give you a good example. Dollar yen moved close to 40 big figures in the past 12 months, and how many people made money out of it?
Only the CTA guys that were following the rules.
Right?
Yeah.
And Kev, I think it boils down to one basic reason, is that the opportunity to trade and to learn bid offer spreads, be it, on the floor, learning bid offer spread on a futures floor, being a spot FX dealer, being a market maker in options, these sort of things. Those jobs don't exist anymore.
Yes,
right. And and even the training ground of working on a night desk where you traded stocks and you traded equity futures and you traded gold and you traded Japanese basis or Korean NDFs, right? Those jobs don't really exist that much either, right? So where do people learn to trade?
And not only that, the ones that have learned how to trade, it's been in a low vol environment. Like a zero vol environment for FX, in essence, like almost, right?
Yeah.
So anyone that's made it has kind of been pre-selected to be a better trader of low vol. And now that we're going to a higher vol regime, we're in trouble. And to your note, I've noticed now I don't really understand this, but there seems to be a lot of people that do macro from Brazil. Lovely people, terrific people. I just love them to death. And they seem to love macro. And the thing is, they also seem to be getting a lot right. And to me, it's because they've been used to inflationary times and they've been used to trading macro and trading these sorts of things. And they've gotten a lot more right than the people that have been kind of stuck in this 10, 15 years of kind of disinflation.
Mate, I think that's fair, and I'd say the other group of traders that has done very, very well is commodity traders.
Yes.
So whether it's well, the guys who do, like, I know a bunch of soft commodity traders who do really, really well, and and that's because they've just lived with such inherent volatility in their markets that they've adapted.
Yeah.
And look, I mean, look at this. We are in the midst of a regime change, right? It's undeniable. Now, I'm not a big believer in the notion that we're going to have rampant inflation forever, but I think the days of us going back to a QE environment, not that central banks would hesitate for a moment to do it again, but I don't think that we are likely to see a scenario, even with recessionary environments, that central banks around the world would resort to QE again.
Right.
And I think we've got a lot of wood to chop between now and the next time that happens. And look, I mean, I don't think the structural disinflationary forces of demographics and technology have gone away. The world didn't get any younger over COVID, and the world certainly didn't get any less innovative over COVID. But I think that we'll put it this way: we finally can concede that the anomaly in all of this was the negative interest rate environment, right?
Yes.
And for me, if there's one point in time, and Adam Tooze is going to be writing the definitive book on inflation as we speak. He's probably doing it as we speak, right? And I think one of the chapters in that book is certainly going to be that the negative interest rate environment was such a structural anomaly, and we have to think we can look back with the value of hindsight and go, that was really fucking stupid. Right?
Yes.
It was really, really dumb. So I know. I think that it's look. There are massive transitions about this. I mean, growth equity's got structural problems going forward. I mean, you've talked about Jim Chanos on quite a few occasions, and I think Jim is really onto something in terms of this. The winter is coming for growth equity. We've seen that before, and we saw that between 2000 and 2009. There was a bit of a real sort of no man's land for growth equity in terms of multiple expansion. It doesn't mean that you didn't have great technology companies coming through during that time. You just didn't have the silly valuations at that time.
Right. So is that what you're looking for? Like a nuclear winter in growth stocks and a period that's reminiscent of, let's just say, right when Julian Robertson hung up his skates and in the dot-com bubble, and then the kind of next 5 years value outperformed growth?
Yeah, I think it's. I don't know if it's a nuclear winter per se, right? Because I still am a big believer that good companies get rewarded for being good companies.
Okay.
I think that you've got. I think what we've seen in the last couple of years is the comeuppance of shitty companies being punished, and I think that is. I think that that's not going to go away. But if I think about things sort of very, very long term, I think that. You had this bursting of the tech bubble from 2000 and 2000 2001. You had the largest cap equities sort of falling 80%. The JDS Uniphases, the Ciscos of the world, which is the one glaring difference between today and 2008 is Apple's gone down, but it hasn't halved, right? And Microsoft hasn't halved, right? And Google hasn't halved. Right, so I think that the quality of those companies and those earnings is so much greater than what it was for the Ciscos and JDS Uniphases of the world back in the day. But I think that the embedded sort of wealth destruction that you've witnessed in venture capital, in private equity and growth equity and the like, is going to filter through for a while. And Kev, I think that we've got what we had in 2003, 2004 was a real turn in rotation to be driven by industrials, cyclical commodities, metals and mining, etc. And that transition was driven by one reason only, and that was China. Right.
Okay.
So China obviously came to the fore with its infrastructure spending program. China's laid more concrete in 4 years than the US had laid in a century. Those sort of stories bandied about. And what I think the right question to ask now is what we're seeing today, exactly the same as what we saw in from say 2002 onwards. But the driver of the rotation into commodities, mining, cyclicals, industrials is not going to be the rise of China, but is it infrastructure spending on climate?
Okay.
And for example, the climate the Inflation Reduction Act and all the climate measures in there. Credit Suisse wrote a report about this recently and said it's about a $1.7 trillion boost to the U.S. economy over the course of the next 10 years. Now, we won't get into all the details. I think that number is way too small. But there is certainly a need for massive infrastructure spending in the United States. We know that, right? The what do we have to spend, like $800 billion on the Texas grid, right? Well, that's half that one. That's half the 1.7 roughly, right?
Yeah.
So
just one state.
Yeah, and that's just one state, right? So that I think that 1.7 number is going to be is far too low. But I think that it could be, if you multiply that out globally in terms of what does Europe have to spend on energy independence in the next 5 years? What does China have to do? What do we need to see in Brazil? What do we need to see in Indonesia? So the numbers of $50 trillion of climate-related spending in the next 25 odd years, those numbers, if they're fast-tracked in the near term, certainly implies that rotation story of into commodities, cyclicals, industrials, etc., could repeat itself, with climate being the driver of that versus China in 2004.
So it will look different, though, because the in 2004, it was concrete they went after, and this time it'll be more copper and solar and things of that nature. Is that what you're saying?
Yeah, but it was a rising tide. Remember, the price of copper exploded during that, right?
You're right. So it's everything, and it's
everything.
And right? I guess if you're building out infrastructure for energy, you're building out everything. You're still using concrete.
For example, you need a shit ton of aluminum to redo the electricity grid.
Right.
And that's the whole notion that that the climate response to the energy transition is one step back to make two steps forward, right? Because you have to produce a lot of really nasty stuff to build the infrastructure around. So, if you build the cost of a 250 megawatt nuclear reactor is about $300 million, of which about $180 million of that is concrete.
Right. And it's actually one of the more ironic things is that as we go through this green revolution, we actually need more energy. And it's kind of I'm perplexed at why governments aren't realizing this and saying, no, you know what, we're going to actually increase the amount that we're pumping and increasing the amount of oil that we find, because we need it over the short run to make the long run better.
Kev, again, I assume we've got 3 or 4 hours to talk about this, because this is, it's such an important story, right? So 2 points. One is that that we produce about 30% of the energy we produce globally is renewables, right? So 70% is fossil fuels now.
Okay.
So the energy transition is not about going from 30 to 100, right? Because if you're going to electrify cars, if you're going to electrify transportation across the board, if you're going to get rid of diesel out of industrial processes and replace it with renewable sources of energy, you've basically got to double the amount of energy that we produce today by 2050. So the number is not going from 30 units of renewable to 100; it's from 30 to 200. Right?
Yeah.
And mate, the problem is that again, I've got no idea how many electric vehicles that will sell globally by 2030. Right? No idea. Tell me about how much lithium we can extract, about in terms of the number of batteries we can produce. Tell me about US charging infrastructure. I got no idea. But what I am really confident in is that by 2030 we'll still have 1.8 billion combustion engines on global roads, between between 2, 3, and 4 wheels. Right? They still need oil. Right, so the notion that somehow we'll be we're not getting to peak oil consumption till, my guess is probably 2045.
Oh, that long?
Oh yeah. Because again, it's not like we may stop selling combustion engine vehicles by 2035, but the last combustion engine vehicle, because the quality of the cars is still good, right? The last combustion engine sold in 2035 is still going to be around by 2050.
And that's assuming that they actually stop in 2035, which is a big if.
And that's a big if. Look, Kev, I do think they will. I do think that they do, because I think the automakers know that it's smart business to go down this path.
Okay.
Right. So I think so. But again, it's what you're seeing with European energy policy is it's a disaster, right? It's just a disaster. The fact that they, the Germans are ruining the day that they flip flopped on nuclear. I mean, I get why they backpedaled after Fukushima. I understand, but looks pretty dumb in hindsight to say we're going to put all our eggs in with Putin. He's been a good guy. He's been a good guy so far. I mean, what can he do? I know he's taken Crimea recently, but he couldn't do anything else. And now it's a disaster.
So what do you think happens to, let's just talk about the fossil fuels for a second.
Mm-hmm.
Put your trader's hat on. Does this cause like a scary squeeze in terms of us running out? Like as we continue to starve the industry of capital needed to make the expansion that is obviously going to be needed?
Yeah, I think there's two things. This sort of short term, there isn't an oil guy that I know who isn't rampagingly bullish.
Right. Okay.
They all are. They're rampagingly bullish, right? And even more so after what we saw in the last few days with the OPEC cuts, right? I think it's extremely problematic, and this is where the whole ESG angle has a real problem to it. And you can be a climate guy, like as you know, as I am, right? Yeah. I'm a climate guy. It's what we focus predominantly on with both View from the Peak and now Climate Transformed. But the defunding of oil and gas has enormous consequences, because again, if we're not reaching peak oil consumption until 2045, and I hope it's earlier than that, but realistically, let's say 2040 to 2045.
Okay.
We can't be making greenfield oil projects cost inhibitive from a capital standpoint, right?
Right.
So someone was saying to me yesterday that Citigroup is the third largest lender globally to fossil fuels, right? And yet Citi is rethinking their lending policies to fossil fuels, right? Now, and the bullshit you'll hear, Kev, about, you'll hear private equity people say, no, the yields will go up and that will attract private capital. No, it isn't attracting hundreds of billions of dollars of investment, which is required by the oil and gas industry to continue this path to make sure that oil demand oil supply is in structural balance on a 10-year view, right? It's incredibly problematic, and it's an accident waiting to happen. And what we're seeing now is that you can't think of this as an energy revolution, right? It's an energy evolution, because the global economy has been just so structurally dependent on fossil fuels for 150 years, right? You need to decarbonize every single supply chain, and that takes technology that doesn't exist. It takes considerable amounts of time. It takes tens of billions, hundreds of billions of dollars of capital to do, right? And in the meantime, until we have, and we do have, the world's greatest minds working on these problems, right? So the most exciting thing about climate investing is it's not 3 or 4 multi-trillion-dollar opportunities. It's thousands of billion-dollar opportunities.
Okay.
That's the super exciting thing going forward, right? But in the meantime, we have to be smart and realize that all countries have to have ample supplies of energy, whether we transition to the transitional fuel, which is natural gas and the like. But we need to make sure that we can't starve the global economy, because if you want to derail the climate agenda, derail the global economy.
Right. So if somebody is thinking about it and they're putting their trader's hat on, or let's not even talk about trader's hat, let's talk about investor's hat now.
Yep.
Somebody's saying, I believe in Paul's view. I think that ESG is going to be bid for a long time. How do they go about, is there a way to pick a basket of these? Is there a way what would be kind of your places to send them looking at for potential opportunities?
I think it's baskets of ETFs. I think it's really sort of a portfolio approach to baskets of ETFs. So we're doing an event in February on climate ETFs, and just so we're doing an interview. So we looked at, so in terms of liquid ETFs, you've got solar, wind, nuclear, batteries, carbon, nat gas, water, hydrogen, EV, and ag sciences, right? So if you were to own those sectors, I think that makes sense from a long term viewpoint, right? Most of the money is going to be made in venture capital and private equity. Is the short answer. But mate, it's not a given that things go the way we think about. So for example, I am bearish on copper.
Oh, why is that?
Right. So I'm bearish on copper, and I think I'm probably the only guy who's bearish on copper. And
you might be.
Right. And here's why I'm structurally long-term bearish on copper, right?
Okay.
Is that we have an electric vehicle revolution going on before our eyes, right? And we know that we need to have 80 pounds of copper, 80 kilos of copper in every electric vehicle, right? That's a shit ton of copper.
Okay.
Right? Shit ton.
Is that a technical term?
That's a technical term. Yeah.
Yeah.
That's yeah. So we need loads and loads of copper for this electric vehicle rollout, and electric vehicle demand growth is going to grow. It could go 20% a year for the next 15 years, right? Could, right? So that sounds like a pretty constructive story for copper, doesn't it?
Yes, it does.
Right. Now you don't need anywhere near as that much lithium in an electric vehicle, right? You might need a few pounds. I think it's about 2 pounds of lithium in an average electric vehicle. You need to 3 pounds of lithium, something like that. But if you don't have the lithium, and we know how short the world is in lithium, if you don't have the lithium, you don't need the copper.
So you're saying that's the real bottleneck.
That's the bottleneck, right? So the bottleneck, so you can only be as bullish on copper and nickel and cobalt and the like based on the tightest commodity within the EV supply chain, and that is lithium. So if you can't get enough lithium near term, you don't need the copper. Now, so I appreciate copper's in more than just copper's in more than just cars and the like, but it's
But if that's the basis, if that's the basis for your bull case, then your argument is that the bull case, the demand isn't going to be as high as you think because we're going to get stuck on the lithium part of it.
It's all about, look, again, what's the overriding theme about the energy transition and decarbonization? It's bottlenecks.
Oh, that's good. Yeah.
Bottlenecks. Look, Russia creates bottlenecks. Pipelines create bottlenecks. Battery components create bottlenecks. Right, and what's going to be even worse going forward, Kev, is when you can't use you need green lithium to use, and you can't.
What is green lithium meaning the way you mine it?
The way you mine it, right? Because ESG goes bonkers and says, well, we can't use nickel from Indonesia because it's smelted nickel. We can only use hydrometallurgy nickel from Tanzania. Therefore, we can only use that, right? And then car companies scramble all each other to buy that stuff, and then don't have enough for mass market cars.
So now, does this mean that we should be looking at lithium mines?
I think so, mate. I think so. I think lithium for me is a no-brainer. I think for the brave trade is to be long lithium, short copper. Is the one I think that's for the brave, and I'm not that brave. But so I do think that lithium makes sense. Look, it's classic gold rush stuff, Kev. It's that you want to be part of the picks and shovels,
right? So right? Do you have any ways to that? Do you have any specific stocks?
Yeah. So you've got SQM obviously is the big one, right?
Okay.
I would look. Rio Tinto are looking looking at getting into lithium, and you know that they're going to do well in this. But mate, what did I hear once that the lithium market is the total volume annual volume of the lithium market is one day's cash flow for ExxonMobil.
It just goes to show you how small the lithium market is and how big ExxonMobil is.
And hence the bottlenecks, right? And that's where you have the potential for bottlenecks. So I think, mate, I think that for me is interesting. I think that, I think if there's one place where the geopolitics and this bottleneck scenario could come into play, is we've been told for the last 5 years that China and semiconductors is the great supply chain problem.
Right.
It's nothing. It's battery production.
Okay.
Yeah. So when over 75% of the world's fuel cells are made in China, right? And they're so for example, 55% of the world's nickel will be produced out of Indonesia by 2025, right? Who do you think funded all that?
I'm assuming China.
China funded the whole lot, right?
Right.
So, I think that if China wanted to, and look, we've been talking about this stuff for 10 years, 20 years, right? If China sells its treasuries, we're all screwed. Or if China stops the iPhone production, we're all screwed. By the way, they were quotes from me, which never happened. But the battery part of this is a real strategic vulnerability.
Yes.
And people are, and the thing, the dumbest thing in the world, Kev, is that what the Chinese car companies did really well is they bought lithium mines.
Yeah, and they went out and secured, like, as a government, did they not go out and secure like 5 to 10 years of supply of all this? Like,
they have. Yeah, and the Chinese have. We haven't.
Right.
Europe hasn't.
Yeah. Well, we've shown how good we are with our energy foresight, with our counting on Putin and then starving our energy fossil fuel industry of any capital.
Tell me, Biden couldn't get a job at Amaranth, mate. He sold oil at 120 and was going to buy it back at 85. He's a genius.
Oh, listen, I wanted him to get it back in just to piss off all those guys so bad. It would have been the greatest trade ever if he had actually sold it and got it back in. I don't think
he didn't want to do it, mate, because he didn't want to earn short-term capital gains.
That is funny. Okay, let's transition a little bit here. It's obviously we're in a bear market. It's ugly. Yep. We've had the worst bond start of, or probably the worst bond year in 100 years, combined with the stock markets had a tough slug. You're one of the few people that are like actually looking and saying maybe there's some green shoots on the horizon. Why don't you tell us what you're looking for?
Well, mate, let's not call them green. Let's not call them green shoots. Let's call it a 10-week window.
Okay.
Right? Let's call it a 10-week window. Right. So any way you look at this cycle is unique. I mean, our good mate Louis Gav at GavCal, the GavCal guys came out about a week or 10 days ago and said that the asset destruction that we've witnessed in
total dollars is the highest it's ever been.
Yeah, it's like close to $60 trillion of drawdown, where you didn't have that sort of asset destruction during the financial crisis because bonds rallied so much.
Right.
And if you look at a 60-40 stock portfolio, it's now the second worst year in history. And just an aside, a 60-40 portfolio has never lost money on a rolling 10-year basis. Right?
Oh, I didn't know that. I got to go look at that.
The power of yield.
Oh, wow.
But markets are what markets are, and markets love to extrapolate. Right? Now, obviously, it didn't happen today, but we are 1 week data point away from, I think, one of the great squeezes that we have seen in years. And I personally think if you get a weak inflation print, right? If you in about 8 days, 10 days, next week? No, it's next week, next Wednesday, isn't it? You get a weak inflation print next Wednesday. S&P finishes the year at 4,400.
Oh,
I mean, wow. The utmost seriousness.
Yeah,
right?
no, listen, the sentiment is so bad that
it's so bad. I put it this way: we've got about 37 clients who we deal with at View from the Peak. Right, every single one of them is either short, underweight, underexposed, or underleveraged.
Yeah.
I
went to New York last week. I went and spoke to people. Every single person is there. There was nobody. You're the first person I've met that is willing to say out loud that there might be some right tail risk.
So think of it. So think about the dynamic of this, right? Why are markets as weak as they are? Markets are as weak as they are is because the perception is that that the regime of 75 basis point hike cycles is going to continue, and that even when we get to the terminal rate of 450 or 475, that will last throughout 2023. Right. So, but it's undeniable that there is the consensus out there is that we're getting a recession next year.
I would agree with that. Yes.
Right? That's consensus, right?
Yep.
So the moment that you get confirmation that that inflation, the declines in inflation are starting to accelerate. So this whole notion of peak inflation, that's all bullshit. Inflation peaked months ago, right? It just hasn't come down as quickly as what everyone thought.
Right.
Right. So what was the dynamic that we had in June, the June rally is? The June rally was we were getting worried about a recession, and we started to price cuts into the second half of 2023, and that was the catalyst for stocks to move higher. You get one bad inflation print, Kev, and the market psyche will be this. The era of 50 basis point, 75 basis points hikes is behind us. 2, if they go to 50 the next time, the next step's 25. 3, if it's 25, it goes from 25 then to pause. And what happens is we start to price in rate cuts into the second half of 2023 because we're in recession in the first half of 2023. Right? And what does that mean? It means that sentiment just feeds on itself, and you could have just a monumental squeeze just on the back of weak data. Now, never lose sight, Kev, of the fact that about Q4 seasonality, right? Now, I won't name names, but I could tell you 10 to 20 leading global investors that have made 80% of their performance in Q4.
Really?
Oh, yeah.
I didn't realize that.
Oh, Kev. Oh, it's one of the great dirty little secrets out there. That Q4 is where everyone makes their money.
What is squeezing it higher and just
it's in stocks, it's in commodities, absolutely.
Oh,
absolutely.
I'm an idiot.
Q4 is where people make their money.
I did not realize that.
Yeah. Oh, yeah. So the moment if you get a snip, well, put it this way, historically, you never want to be short in Q4.
Okay,
right?
I'm with you.
And that's, and couple that with the fact that, again, I hate this argument. It just annoys the hell out of me, but it's the narrative. If the Republicans take the House, and they probably will, because the Dems hold it by such a slim margin, right? If Republicans take the House, you've got the whole gridlock is good for markets argument.
Yeah, but you don't think that they'll go back to that'll mean there's no fiscal coming? Although I guess you could almost argue the market doesn't want fiscal these days.
Market doesn't want fiscal, mate. And by the way, the Republicans take the House. They've taken away Biden's checkbook.
Right, which actually might be a better thing given what happened in the UK.
Oh my God, that was just a disaster. Do you know Liz Truss has an 11% approval rating?
Really? That was
11% approval rating.
Okay, why don't you tell us give us your kind of color, the what you saw there, and any insights that you might be able to share with us.
Well, mate, as a loyal member, as you are, Kev, a loyal member of the Commonwealth, I was actually there when the Queen passed away, and it was actually a pretty remarkable time to be in London. I got to say, it was.
Oh, I imagine it must.
It was really quite amazing.
Did you go queue?
What's that?
Did you go queue to see her?
No, but we did talk. We did walk past the queue because it was 5 miles long.
I know, but that's no excuse.
We were out for lunch.
You're not a very good subject.
Yeah, I mean, it was remarkable. It was a remarkable time. So we went to a place called Borough Market for lunch, and it was on the Thames, and just this thing was 5 miles long.
Wow.
And just chatting, and it was just such a wonderful sense of community. But anyway, so the Queen, obviously the Queen is buried. Then reality checks in, right? And it actually made one thing that stood out to me with all of this is the Bank of England's intervention into the gilt market just exposes to me this argument about macro not being as good as what we think it is leverage is embedded across all parts of the asset management system, right? And we speak to smart money all the time. How many people that you know of knew anything about the leverage in the pension market, in the defined benefit market? No one.
Yeah. You
No
don't get
one
me
knew.
started, Paul. Like, this is the nature of crisis. They wouldn't be crises if everyone knew about them, because everyone would have positioned for it. By
And
its
we're
very
so and mate, we're so smart about this. Apparently, so smart about this.
yeah.
And it just it was it was just a complete and utter comedy of errors. And literally, Liz Truss is sitting there pretending, looking in the mirror in a second day of office, doing her best Maggie Thatcher impersonation, right? at a time where the market just had no appetite for policy that contradicts,
Yes.
right? But again, the UK, and Boris Johnson used to talk about this all the time. He wanted to be the Singapore of Europe, where what Liz Truss did was straight out of Ankara, not Singapore. Right?
I do think it was interesting that it was the first time that fiscal wasn't greeted like a positive for the markets, and it was also the first time that we saw central banks push back at the rate upon which real rates were rising. Meaning that up until this point, most central banks have actually been going out of their way to raise real rates because they wanted to slow down inflation. And this was like, whoa, the Bank of England was like, this is way too fast. Things are coming unglued.
Well, but there was a legitimate financial crisis there in the pension industry.
You think it was really bad?
It was really bad. I mean, the Bank of England came out and said they were out. There was basically implied they were hours away from insolvency.
Wow, it's just shocking.
Yeah,
it's just shocking, and it just shows you how much, like, to your point, things are just on there by like a string of times, and it's kind. I find it shocking time and time again how there's so little respect for how easy it is to blow it all up. Like, even Powell, I look at him and I get it. I understand why he's hiking, and I understand why he keeps pushing on this, but I'm with you that there could be a rally and that we could get this. But I'm also scared that he was just kind of Thelma and Louise it.
Right. But Kev, here's the problem with next year, right? The problem with next year is, let's say I'm right and we go to 4,400 on the S&P, right?
Yeah.
Right. The problem is next year, so we all agree that the consensus is there's going to be a recession in next year at some stage. Now, that could be a mild recession. It could be a more substantial recession. It's not going to be 08 because we're not going to have the balance sheet destruction at banks, but it could be, could you have a 10% decline in earnings? Yeah, you can see that. That's, garden variety recession, right? But the problem is, from a market standpoint, we're going into that recession period at 4,400, which would be 18 times forward.
Yes.
Right. We're going into a recessionary period with credit probably below 450 over. Right. That's really expensive assets going into a downturn.
And you could make an argument, which Stanley Druckenmiller is making, is that we're going to have 10 years of just this deflating of financial asset prices.
Yeah, I think I can see the argument about growth equity, as we talked about before. I don't know if it's applicable to some of these mega themes, such as particularly do you want to be short Alcoa? Do you think there's going to be a derating of Alcoa if you go to spend $1 trillion on aluminum?
But 1 second, how much is Alcoa of the index versus how much is Google, Facebook, Amazon, Netflix?
Oh, 100%. So that gets you. So again, I think that you've got to think about it, Kev, in terms of expected return, right? So if you've got let's say, my original premise, which proved to be sort of about 60% right, no more than that, right, was that the pain would be this year, and then the rebound would be next year. Now, we were never going to rebound as much, but we were going to get a rebound next year. But the rebound next year was premised on the fact that asset markets were cheap enough to rebound going into next year, right? Now, if we finish 2022 here, right, at 15 times forward and credit approaching 600 over, right? Yeah, they're relatively, they are assets that have adjusted in price, right? As a market, right? It's hard to see how you have another 20% lower from 15 times forward, if the terminal rate is only going to be less than 5%. Right? Hard to see how that happens for me, right?
Okay.
Right, because the 1990 recession, you got to 11 times 2008, you got to roughly 11 times at the lows. But the terminal rate in 1990 was 975, right, prior to the 1990, and the terminal rate prior to the crisis was 575, right? So you should think that it's going to be some premium to that if rates don't actually get as high as what they have in previous cycles. And I think that's a valid argument. But if you start if you start next year like at 18 times forward, right? That's where can markets go under that scenario? Because you're going to have earnings are going to fall through the course of 2023, right? That's clear, right? And for markets to stand still, do they have to go to 19 times forward, 20 times forward, right?
Yeah.
You're not going into recession at 20 times forward, right?
But
you go to recession at 15 times forward.
But the kind of the paradox of that is that we could actually go into recession and yet have the Alcoas and all those companies going up in price. They don't need to move together. We could have.
They don't. No, they don't.
Right, and that's the part that everyone I think is missing. We're treating the stock market as one big huge bubble, or not bubble, one huge blob.
Yep.
And if there was ever a time we should be separating it, it's now, because we have this blob at the top that is such a large portion of it that will behave much different than the other portions. Like your secular argument about ESG and about climate change spending could fuel that section for a long time to come. We could have energy continuing to rally. And what we find is energy and climate and all these things, and maybe some industrials are bid and those things work, and everything else just that, the defensive type stuff that people are hiding, and then the extreme,
growth,
they all sell off.
Yep. So, Kev, who do you think's happier this year? T. Boone Pickens' grandkids or Kathy Wood? Right? Because again, we think about these things. We think the market's down 20%. We think of this in a very homogenous way, right? But if you're in the oil and gas industry, put it this way: Houston as a city is in better shape than San Francisco.
Oh, that's a perfect way of putting it.
Right.
Because, it's only going to get worse. The discrepancy between the two is only going to get worse. That's not going to go back to what it was in 2010 to 2020, which is what I think everyone's assuming.
Yeah, and because again, I think the main difference is that and I think it's less in public markets and more in venture capital for me personally. I think that the notion of venture capital being able to raise tens of billions of dollars to provide, to fund just, any shitty company that it wants to at ridiculous valuations. Those times they're over. They're over. Right?
And don't you think there's a problem in that they haven't been marked to market yet? Like every asset in the world is down, 10 to 30%, like every major asset class. And yet I see like private REITs marking up and private debt. And like, I feel like there's a lot of mark to fiction occurring in those places.
But I think growth. I think like the high quality firms like Tiger Global's marked its book down. Now I don't know if it's rock bottom. I don't know if it's I don't know where they've marked things. But if you as a portfolio are down probably 65% on the year, right, with your privates, right?
Well, you think that there are people marking down that much?
Yeah. Well, what's Tiger Global down? Tiger Global down at the start of Q2 was down. I haven't seen what they marks were for Q3, but I know at the start of Q2 they were down 50-odd%.
But I think their public stocks were down at least that amount, and I'm not sure.
Right, but they can't. They're under. They can't just fudge they can't just have their exposure to private tech companies. They can't be marked at book if the public market peers are down 50%.
Yeah, I hear you. I just think at the margin there's a lot of games still being played there.
Well,
maybe I'm wrong. Maybe it's too much.
True,
yeah.
But Kev, sorry to interrupt, but I think that's true. But I also would say that the bigger issue is the fact that you can't get out of these positions.
Yes,
right. Because if you're in a Tiger Global fund and you've got a 5-year lock, right?
Yeah. It's Hotel California. You've checked in.
Can't get out.
Yeah.
And by the way, every major family office in the US, well, loads and loads and loads of family offices have money with Tiger Global. You can't appreciate how big that fund grew from a venture capital standpoint.
I didn't realize that
Oh, it's
particular.
huge. They just massive exposure to this place. Massive.
I also think that everyone throughout the world is overweight the FANG mats and overweight US dollars. That's one of my themes that and it makes sense because if you think about it, managing money on a long-term perspective, if you weren't long those, you lost your job.
Yeah, and I think, mate, the dollar scenario, I think, is an important one, particularly going back to this tactical approach that things could get explosive in the next 10 weeks. Put it this way, the moment you get a weak inflation number, go out and buy every emerging market you can find.
Oh, I'm with you. But
Right.
but oh wait, and actually you're a perfect guy to ask this. A little part of me is worried about buying Asia, and I think maybe I should be separating them more and buying, like going out and picking the Brazils and the Mexicos, and really thinking about them as in different buckets. What do you feel about that? Can you still look at them as one? And would you want China in there? Like, what are your
so China's the key thing, right? So if you go and buy EEM, or if you go and buy any sort of MSCI linked EM index, it's dominated by China, right? So that's problem number one. And China, China is, I get asked every day, is China investable, right? And that's a totally, we'll put that to one side because it's just too long a conversation. But I think you've got to look at this in a very idiosyncratic way. I think you can be long commodity driven EM. I think that does well. The Brazils, the South Africas can do well. The Middle East can do fine. All this sort of thing. I think if you're Malaysia, but if you're an importer of oil, you've probably got some struggles. I'm surprised that India's held up as well as it has. That's probably because you've been out pounding the table on India for the last 3 years.
Who was it? Was it Vincent? No, who was it? Was it Vincent Duval? No, it was. It was Marco Papic that brought me up on that, because I went in when I wrote up my original Buy India a couple of years ago. Marco Papic said, "No, you're insane," and it was basically that. He was saying that they're big importers of commodities are going to get crushed. And to his credit, he has been saying, "Yeah, I should have listened to you, Kev." But even the blind squirrel finds an acorn every now and then. Okay, we're getting on. So actually, we should maybe get to the point where we ask you some questions. We've already done the 3 regular questions we have, so we thought we'd get the 2 other ones that you hadn't asked the last time. Right. So we'll start with the Byron Wien market surprise for next year, and we'll define a market surprise as something that the markets expect less than a 1/3 chance of occurring, but has, in your view, a greater than 50-50 chance of happening. What would be your Byron Wien surprise?
So my Byron Wien surprise would be the price of copper goes up considerably. So I would say
you said copper. You mean something else?
Sorry, copper, not copper, carbon, I should say. Sorry,
yes.
Carbon. I'm bearish copper. So the price of carbon goes up and could double next year, particularly in the voluntary offset space, right? So so quickly, there's compliance markets like the EU ETS and the California markets and the like. So if you're an airline and these sort of things, that's the markets you're compelled to play in. They're compliance markets. The voluntary markets are a little bit less liquid, but for example, Crane Shares now has an ETF on this sort of stuff, and that's the price of this stuff. I think could more than double in the next 12 months. And it all boils down to SEC disclosure requirements about Scope 3 emissions, right? So the SEC is on the verge of finishing its consultation on whether or not US public companies need to disclose their carbon emissions, and disclose other sorts of emissions. The moment the SEC announces that that public companies, big and small, have to disclose it, it means that corporate treasurers are going to scramble all over themselves to find offsets to show that they're doing their best to get to net zero. And this is all, the net zero pledges at the moment are all just marketing and smoke and mirrors. But the moment that the SEC or the FSA or the ASX in Australia mandates that the companies have to disclose their Scope 3, it's public record, and then it's pretty hard to say that you're going to net zero if you can publicly show that your carbon output is X, right? So how do you offset that? We can go into voluntary markets and actually buy voluntary credits to take the other side of to mitigate that risk. And Kev, there's just not enough of them out there.
So
There's
this is
just not enough.
is this KRBN as in Kevin, Robert, Bob, Nancy?
KRBN is the compliance one, and
Okay.
I knew
And
you'd
do you
ask
have a
this.
date on this SEC when this is going to kick
Well,
in?
my guess is it probably is going to be formally initiated in the end of next year, right? But treasurers will run ahead of this.
Okay, so at the end of 2023 is then when they'll have to have it on, but they will buy it ahead of the time.
I think that's probably That's so again, if you talk about where things are sort of skewed in the wrong way, I think that's skewed in the wrong way.
And this is, in the meantime, this is just something that other, like, it doesn't, there's other demand. So why don't you just talk to us about, like, without the SEC, without this change, why would you people, this is probably still something you would like to be long. Is that not correct?
Yeah, you do, because it's all about net zero pledges. So the thing is, a great example of this is the airline industry, right? So, I fly United, and every time I get on a United flight, I see Scott Kirby, the CEO of United, get on there and tell me, literally surrounded by more like tropical fish and rainforest than you care to imagine, right? Telling us about how green United is as you're sitting on the tarmac, smelling the jet fuel coming through the windows, right? And there is just no way on God's green earth, technology just doesn't exist, right, to decarbonize flight it doesn't exist currently. And even if you could get hydrogen planes, which are, if I was to walk you through the science of a hydrogen plane, Kev, it's the most terrifying thing you've ever imagined.
Yeah, right? I don't want to hear it. And I'm sure it's a long way off.
The wings have to be, the internal temperature of the wings has to be minus 252 degrees. And if it's minus 251 degrees, the plane blows up. Right, so,
blows up. Oh, nice. Okay.
Yeah, nice. So let's say that technology we need to work on that a little bit. And so the prospect of decarbonized flight is an absolute pipe dream, right? But yet Scott Kirby makes these claims, and Michael O'Leary from Ryanair makes these claims, and they're just not going to happen. So what do they have to do? They have to go into the compliance markets to show that they're mitigating their risk. I mean, the whole notion of sustainable jet fuel is just it's literally made from used cooking oil.
Okay.
Right. That's one of the ways you make renewable jet fuel, right?
It's not going to happen. We're not going to get
not very scalable. Yeah. So I think that the prospect of this happening is very, very slim. So, and this is not just about airlines. It's about steel companies. It's about mining companies. It's about the transport. It's about shipping as an incredible polluter. The industry outside of basic commodities. What do you think? Which industry is the biggest polluter in the planet outside of basic commodities?
I have no idea.
Medicine.
Really?
Medical, because there is so much, obviously to make drugs, it's got lots of toxic waste on drugs, but it's all the single use materials.
Now, this trade was very popular with the hedge funds last year, and it's I would say that it's come off in 2022, but it hasn't come off that much. But one of the things that I worry about when I think about this is a self-imposed restraint or constraint.
Yes.
And given the cost of energy is going up in such a big expense, what happens if governments just say, you know what, we're gonna issue more of them? Because couldn't that happen?
Well, they do issue more of them from time to time. That is true. But they do want to have some sort of balance to the market, right? Because at the end of the day, the price of carbon globally is just too low. So I'll give you a good example. So you can buy a hectare of land in the Amazon, right, for $500 a hectare.
Okay.
All right. Sorry, wrong. For $100 per hectare.
Okay.
Right? Now, the reason it's so, and so that's why it's so cheap for indigenous communities to sell strips of land to cattle farmers or soybean farmers, right? Because they can burn the forest, grow soybeans and sell those soybeans to the equivalent of $400 a hectare. Right.
Okay, I'm with you.
So the price. So if you can get what we need is the price of carbon to be upwards of $500 a hectare. Right. Right. So the price of carbon is too cheap. So there's no real incentive outside of marketing and customer demands and stakeholder demands for people to stop doing what they're doing. So the European government can't just go out and issue, it doesn't want to issue a slew of new compliance offsets to get the price down, because lower prices don't instill change.
Oh, and there's not, at these prices, not enough change is happening, you would say.
No, because look, again, putting what Putin's done with gas to one side, it's a golden age for coal right now.
Wow.
Right? Because the price of coal versus the price of carbon, the spread's too wide.
So this would naturally, if all else being equal, if there wasn't all this shit happening, you would actually like to see this as a government going up in price, not down. So you wouldn't be issuing more of them. In fact, you might be pulling them.
Correct. So there's a reason. So the Californian the compliance markets have a 5% automatic step up each year, and also they're linked to inflation.
Okay.
So that's a nice little 13% yield you had on those things this year, right? and that is designed to make sure that the price of carbon over time becomes more and more inhibitive.
Okay, I see. All right. So the next one is, we're going to do Canadian now. We have the famous Canadian strategist, Don Cox. He said that you don't invest on what's on page 1 today. You invest on what's on page 16 on its way to page 1 tomorrow or next month. Yep. Do you have a Don Cox pick for us?
Got it. So, Matt, I would say that, looking at all the climate stuff that we do, and we're blessed with at Climate Transformed that we get to interview some of the great sort of innovators and entrepreneurs in climate tech. I think something that's flying well and truly under the radar, and people have effectively given up on it to some degree, is the notion that you can actually make steel and cement green. And there's one company in particular, which is a private company called Brimstone, which is a green cement company, which is just doing amazing technology in terms of effectively producing cement through means that doesn't require enormous amounts of CO2 to be released in the air, because you have to heat the limestone to such an extent, right? So these processes of owning technologies around green cement and green steel, which people have effectively given up on in a lot of ways, the notion that you can actually decarbonize the steel industry or decarbonize the cement. This stuff, I think, is just remarkable. It's just remarkable. It goes. There's no trade there. There's no trade there per se, outside of appreciating that there are steel company. Who are the companies that are investing in things like green steel and green cement? It's BHP, it's Rio Tinto, it's Anglo American, it's Glencore. These are the companies that are all investing in them. So, mate, if I was to say, the trade around this sort of stuff is to continue to own owning mining companies and the like, because they're BHP Ventures, which is the venture capital arm of BHP, is investing, just throwing $50 billion checks at everything,
that's
right?
fat.
Because they know that they need to be. Well, put it this way. I think about it this way: if you're a Stanford engineering grad, right, you're doing one of two things. You're going into blockchain, or you're going into climate tech, right? Yeah. With all due respect, they ain't going to work at BHP.
Yeah. Not anymore. You're not going into blockchain,
right? So exactly. Therefore, BHP knows that it has to acquire these companies or have stakes in these companies, right?
And so, do you get BHP Ventures when you buy BHP?
Yeah.
Oh, you do. Okay.
Yep.
And so BHP has an arm like this. Glencore has an arm like this. And what was the third one?
Rio Tinto does. Anglo does. I'm sure companies like Freeport do. Because mate, they know that they probably wouldn't explain it this, but the entrepreneurial culture, right, that exists at a Google or an Amazon or a Microsoft doesn't exist at Glencore.
Okay. And
Glencore, bad example, doesn't exist at a BHP or an Anglo American.
So that they have to acquire companies.
So they're buying these companies or buying stake and certainly putting up a lot of money at a venture level into these companies.
Oh, that's fascinating.
Yeah, so a very cool company, a very cool company called Kabanga Nickel, which is a Tanzanian green nickel company, which will start coming on operation in the start of 2024. I think it's AIM. I think it's AIM listed in the UK. But they'll produce 100,000 tons a year by 2027 of legitimately green nickel. And nickel's horrible. Nickel of all these metals, nickel's probably so a ton of nickel pig iron produces 50 tons of carbon.
Okay, it's the least green. It's the most purple.
Most purple.
I don't know what the opposite of green is. Red, I guess red. If I got that right, because green's a basic color.
It's a primary color. See, there's no opposite to green.
Okay, I didn't know. All right.
No, it's not. Blue and green. Blue and yellow make green.
Okay. Listen, why don't we, since we're on the topic of talking about green investments, why don't you tell people more about View from the Peak, what you guys do, how people can learn more about it? You mentioned you were having a conference about the different ETFs. Why don't you give us the whole spiel?
Yeah, sure. So View from the Peak is the institutional research business. We've been that's been around since 2011. That sort of does its own thing. I write every Sunday, which is, Kev, the dumbest freaking thing I've ever committed myself to for writing every Sunday for 11 years.
It's almost as dumb as doing a Friday podcast.
Yeah, exactly. It's not the only reason I don't go to church on a Sunday, but it's pretty much probably the main one. But what we've done, Kev, is we've done a real pivot into focusing on climate, which is through Climate Transformed, and Climate Transformed has a goal of doing 500 hours of interviews in the next per year. With the leadership that's going to drive us towards a more sustainable and decarbonized global economy. So we look at everything from nuclear energy, we look at hydrogen, we look at carbon offsets. We're doing our big conference in December 6th through 8th is going to be called Climate 2023, which, as it sounds, is a preview of the year ahead for climate across 20 odd sustainability sectors. We've got interviews with. We've done interviews with Microsoft. We've done interviews with Standard Chartered, with Amazon. We're planning on interviews with a bunch of sequestration companies. That's what keeps me off the street at night. But that's all at climatetransform.com is the main place for all of that.
All right. And so now I can't let you go. You mentioned China, and I'm not going to make you go into the whole 9 yards, but you are a little bit of a China expert. You did spend a lot of time in Asia. Do you think we have seen the end of COVID zero there?
So, Kev, the thing is with policy in China is there's never an actual formal announcement about
exactly. So I'm not expecting you to say that there's going to be an actual announcement, but do you think it's occurred and it will be a silent transformation?
If it does, when it does happen, it will be a silent transformation. I mean, I will just say the one thing. I've looked at China for a very long time, right? I'm utterly bewildered about what happened in China this year. Utterly, I just have no idea why they did the things they did. I mean, this is a country that has had the most stringent COVID lockdowns of anywhere in the world. This is a country that spent less on a per capita basis on supporting companies and individuals than any other country in the world. And that's all happened at a time where it has a leader that is going back for an unprecedented and quasi, it is dictatorial, but a third term as, and effectively ruler for life. This is a guy who's, Xi Jinping's had, screwed up royally on many levels in the last, particularly the last 12 months. Taiwan, support for Russia, COVID handling, housing crisis. It's a mess. And yet they did nothing to stimulate that economy throughout going into the party Congress. I will never understand why. Don't understand why.
Well, that's a refreshing answer.
But it really is. I just because it just flies in the face of every logical thing that you would do if you were Xi Jinping. Right?
Yeah.
We all know that China is a political economy first, right? The politics is first. And the number, look, at the end of the day, what's kept me in good stead about looking at China over the last 20 odd years is the following. Number one goal of the Communist Party is preservation of the Communist Party. Right? It's the only thing that matters, right? The party trumps all, because the party ensures social stability in China, and that is the number one goal. But why would Xi Jinping underspend during that time? Why would he not support his citizens during that time? I get there's been a clampdown. I get the common prosperity arguments. I get all that sort of stuff. But he took an enormous risk going into the party congress, not stimulating. They had plenty of firepower. They had plenty of ways to do this. They didn't need to not do this. For me, it was just a risk that didn't need to be taken, and I just will never understand why they didn't go down this path.
Okay. Well, we got to leave it on something more fun. So let's just talk. First of all, thank you again for the pizza. And for those who don't know, Paul is just a terrific fellow. He came up for our Market Huddle Piss Up, flies to Toronto for what? Did you even come for the night? Like, you might have gotten the plane in the morning.
No. I was there for 7 hours.
Yeah, you came for the Piss Up, 7 hours. So thank you so much. It was a pleasure having you there, and it's always great to see you. I just want you to know our mutual friend, I don't think he'd mind us using his name, Rupert. He's coming to visit me as well, and I'm a little worried. He talks about wine and boozing a lot.
Mate, pound for pound, he's the greatest drinker I know. Because he's not a big guy, like he's a little guy, but pound for pound, he could be one of the best drinkers I know. And at the age of 50 plus, he's an experienced veteran.
Well, it's always. I'll tell you, when I was young, I went on a squash trip to go play in England. And we went, and our first place we went up to was in Liverpool. And we went up to Liverpool, and I think I was 16, maybe 15 or 16 years old. And we went to some community event, welcoming us to the thing. And literally a 12 or 11-year-old stole a bottle of like rye or something. And we went behind the shed and drank this thing. And the 11-year-old drank us all under the table.
The 11-year-old did.
Yes, from England. I just think it's something they're born with. I think that there's a genetic mutation or something, and they just start so early. They're good at it.
We had an English exchange student who came to our school, and he and I went drinking. Like, I went to university and sort of came back. I was 18. Came back home. We went to the pub and met him at the pub. I don't remember much about getting home, but I remember that my mother woke me up spraying me with the hose as I was passed out on the back porch, while literally he's standing there, literally like nothing, like literally he just had his morning coffee, right? and he was about 5'3" and just drank like a fish. It's in their genes. It's in their genes.
All right, we're going to leave it on that story. That was that's a great way to end it. Paul, thank you again. So go check out View from the Peak and Climate Transformed. And thank you again for your time. It's always a pleasure.
Thank you, Kev. It's always a pleasure, mate. And you guys do such a wonderful job, and everyone support Kev and what he does. It's marvelous, and we need to do more of this. We need to have more voices like Kevin's out there.
Thanks again. Take care.
Thanks, mate.
All right, Patrick, it's time for Talking Charts. It's definitely been a tumultuous couple of weeks. What do you got in store for us?
Dude, we got to talk about this. Like, why is it that we always don't have an episode when shit hits the fan?
Well, it's Murphy's Law.
It is like, it's like we each week we kind of come together and like, well, nothing's really happening. We got to wait. And then we go, okay, we got to take a week off. And suddenly,
well, we're going to have to get used to that. It'll be every second week now. So there'll be a lot more happening in between.
There you go. All right, listen, let's a few weeks ago we were talking about the top 3 things. I'm just going to quickly highlight what they were, because in the end it's already 2-3 weeks old, so it doesn't really matter. But we were asking about whether oil was going to continue to decline. We were looking at that post OPEX volatility and the FOMC meeting, and obviously all of them did come into play in many ways. We need to talk about all of these again this week, right?
Yes, especially the FOMC.
Yeah. Again, like we obviously had the jobs numbers, and there's obviously speculation now as to whether the Fed is going to pivot. I know you wrote something about that. What's your feeling?
Well, I think that pivot is the wrong word because we're a long way from the Fed pivoting. I think just whether the question is that they pause or not. Geez, Patrick, with this jobs number looking increasingly difficult, Paul went on about all it'll take is 1 week number for them to get closer to pausing. I hear that. I understand that argument. I've given up trying to call it because the reality is that I had been expecting them to slow down much before now. I've been shocked at how hawkish they've been. I understand the reasons that they've been hawkish. I just didn't think that they would follow through as much as they did. And so the surest sign that the pivot or the pause, I'm doing it too, Patrick. The surest sign that the pause is close, Patrick, is the fact that I haven't been calling for it for a couple of weeks now.
It's definitely coming soon.
Exactly. It's probably going to be this fun.
All right, let's talk about the top 3 things to watch this week. Now, what a reversal back down in those equities. Number 3, I actually expected this bounce to even be a little bit stronger. I thought that we could end up seeing 3,900, even under the right conditions, 4,000, which is typical 300, 400 point bounces that we've seen in these bear market little snapback rallies. But after a 2-day little run on the upside of a couple hundred S&P points toward 3,800, and here we go again, right back down toward their lows. And it just seems like the bulls can't get their footing here. And I'm really wondering whether or not this is going to cause some follow-through selling. There's a number of targets that we have measured out towards 3,400. And will the market break to a lower low is one of the key things I'm watching.
It was a tough close as well here on Friday.
Well, that's exactly it, right? Like when you look at this chart here, you can see that. Let's just highlight this, Kev. So we have a scenario. Like look at all of. I'm just going to use the same oval here to kind of highlight. But look at this rally, or this one, or this one, or this one, or even this one back here in June. I should be highlighting the dates since some people are listening to this versus watching the charts. Point is, each one of those on average is 300 to 400 points. In terms of its reaction, and just look how fast and quick this market turned down after such an incredibly oversold condition. It just feels very vulnerable at this stage, and obviously there's a number of analysts out there that are anchoring still off of 3,200 or 3,000. Right now, my initial target, if we break to a lower low, is just 3,400. But obviously, once we get into some sort of a liquidity pocket, you never know whether or not the markets gain some downside momentum. Things just really kind of almost capitulate in some degree or another. It's going to be really interesting to see whether the bulls can dig in and prevent it from dropping to a lower low.
Certainly didn't feel like that today. Okay, so what's the number 2 thing you're watching for next week?
Well, the U.S. dollar.
Of course. I wasn't involved in this, so I'm actually only surprised it wasn't your number 1. I'm looking forward to the number. Oh, I know what number 1 is, but yeah. All right, let's talk about the U.S. dollar.
But the U.S. dollar put in its a little short-term high back over here on the 28th of September, and it kind of peaked out around 115 on the upside. And really at this state, it kind of began, it began a very clean retracement. The retracement gave back almost a solid 5 Dixie handle points on the downside, and really asked the question as to whether that dollar pause was going to put in a short-term or even an intermediate high in the dollar. Almost every major cross-currency, gold, so many different commodities and other markets all reacted in a risk-on manner the moment the dollar pulled back. But after just 5 days of selling, that dollar index is heading right back up. I mean, if we start clearing 113 on the upside next week on Dixie, it really could set in motion another full leg higher. And I'm not necessarily predicting it, but we do have to acknowledge the dollar uptrend is the primary trend. It is the dominant trend. Old dips have been bought, and this is again a dip that was bought. There's no reason or no technical way we can confirm or even suggest that a dollar top is in. And so the path of least resistance is for this thing to go higher. and I'm wondering whether another dollar rip could just be that intermarket event that just causes another spill in so many of these risk assets.
So I got a funny story to tell you. Pull up the euro. As you know, I have one of my currency, the smartest fellows I know on currencies. I was lucky enough last week to go to New York City and spend some time with him. And he lives in Brooklyn, and he was kind enough to show me around Brooklyn because I'd never been to Brooklyn. And on the way out, he was putting me on the ferry because I also never taken the ferry. So I was taking the ferry across the river. And the last thing he said to me as I was getting on, he said, "Don't cover your short euro." And he screamed it out at me like I'd be short euro. But anyways, the funny thing about this, Patrick, is that the fellow beside me, shows you how the world's changed, starts asking me, "Oh, so he really thinks the euro's going down?" And this fellow wanted to know all about currencies. And it shows it was kind of a sentiment change for me because usually people would be talking about Bitcoin or stocks. Yeah. And it was interesting that this civilian, because he was just a civilian, not somebody in the markets, was aware and interested in currencies. But the real kind of, I'm burying the lead, the real message, the currency savant, he's with you, Patrick, and he's still pushing on the short euro trade.
But the problem I have with this is that the US dollar move is so overextended. The dollar's gone so far. And so what we have is this struggle where there's very little asymmetry like in terms of returns, because almost all of the dollar gains, easy dollar gains, are all rear view mirror.
I guess so, but he thinks there's a lot further to go.
No, but like
you could have said that well, listen, I'm not trying to argue that, but
okay. No, let's just go through that scenario. Let's say let's say we see 90 cents on the euro.
Okay.
Or even our milkshake man Brent's call, I think, was like 85 cents on
Is that
the
what
euro.
the milkshake Brent says?
I remember hearing that. I don't know whether that's his current stance or not, but I remember hearing him say that number. And so that we're talking anywhere from 700 to 1,200 pips further for the euro to go on the downside. But the euro in the last 2 years has already gone from 123 down to 97.
Yeah.
Right. So the thing is that the majority of a dollar long or euro short has already happened. Even now, yes, there is a trade to the downside if it does go to 90 cents. And you are a swing trader and you can catch the turn down and you want to clip yourself 300 to 500 pips, you might be able to catch it. But it's a trade. The thing is I don't think there's any easy, just buy US dollars long against the euro here, because the euro is going to sustain below parity for a long period of time.
You just didn't listen to the milkshake theory enough. Go back and re-listen to it. Then you'll know.
Then I'll know. All right. Anyway, so let's quickly get to the last top three, and then we'll talk some charts. Okay. So inflation numbers again.
We have CPI and PPI.
PPI, yeah, exactly.
And
what are you gonna make a call on this?
I was looking at what the inflation swap market had priced in. The inflation swap market's slightly above the Bloomberg median estimates. I can't remember the exact numbers. I think it's 0.22 on a month-over-month basis. I think the CPI is at 291.16 right now, and I think the inflation swap is sitting at 291.60. Long and short of it is we're expecting a slowdown on the month-to-month numbers, but the reality is that the year-over-year numbers are going to continue to look bad. So do we get enough of a dip that it actually even makes the year-over-year numbers look better? And do people understand, do you think markets care and understand, or even more importantly, does the Federal Reserve care and understand that if you could have inflation actually running negative and we still have year-over-year inflation running much above the target because of the previous rises? So I don't know. I'm not sure, Patrick, what is good enough for them, and I'm not sure how much you need to change policy. Paul is of the belief that you could see 1 week number there, and it would change the whole sentiment and attitude. I kind of think that the Fed is more interested in employment than inflation. That's really what I've been kind of rethinking, is that the Fed's really not going to be happy until they put people out of work, which is kind of crazy, but that's what. No, honestly, that I'm increasingly believing.
When you put it that way, it's kind of brutal. But
yeah, well, listen, that's what they're saying. And that's, anyways. I don't know, Patrick. I think it's become tough. Lots of emotions, lots of volatility. All I know is that every time we seem to get either an employment number or inflation number, we get one of these big ugly days. Like today was an employment number yet again. Opens kind of gaps down and then just gets sold all day. Seems to be that's the trend. One of these days it'll be the opposite. The fact that I'm not calling for the opposite is probably the best signal you guys have out there that it's going to come. I don't know. I'm not sure. I'm not even sure that a weak CPI number is enough to fix it at this point.
Yeah. All right. Let's talk some charts, buddy.
Okay. What do you got?
Pound sterling. We literally recorded and then it happened, and we haven't had a chance to talk about it. But what a little flash crash! 1,000 pips in like 20 trading hours, spread over 2 sessions. But what's interesting is whenever you have these kind of capitulating sell-offs, often it could actually mark where the low is going to come in. And now often that will still go and retest it. So by no means is it all upside for the pound sterling, but it would be really interesting to see if during another dollar leg higher, whether it stays above that 104, 105 level. Maybe at that moment, one could start leaning in that little flash crash could have marked the lows of the pound. What are you thinking?
Sounds like someone's getting bullish.
No, I just don't think it's
but at the margin, you're
downside.
bullish. Like if I said to you, gun to head, buy or sell, which one are you?
I would be a buy when it gives a proper new buy signal.
I have a gun
I'm
to your
flat.
head. You're not allowed to do that. You're not allowed to choose.
Okay.
Gun to head, you got to choose long or short.
All right, fine.
A timeline.
I'll go long.
I'll give you a timeline. 3 months.
No, I'm going long.
That's what I thought.
But you know what? But listen, don't anyone go and do it, because I remember I had a
you're
gun
assuming
to my
people
head.
listen to you, which is just not a chance. They're using us to fade. Like they're listening. It's like most of the time they're just like, yeah. Just find something you both agree on, so I have a good signal. Like that's all they're looking for. That's really
and you know what? That means we have really smart listeners.
That's
so
right. That is the alpha gold that is in our podcast.
All right, let's talk about this U.S. dollar yen, because obviously
Jesus.
they've been trying to intervene, and yet that U.S. dollar crawling higher. It's like, do you think they're going to be able to hold and defend the yen here?
Yes. Do I have a position? Yes.
So you're okay. So listen, all our listeners now know. All right, because Kevin and the Bank of England are the wall.
No, Bank of Japan. We're standing We're standing in there.
Yeah,
there. I'm going to buy another 3 contracts. I'm buying another 3 and another 3.
There you go.
No,
okay.
Patrick,
So
in all seriousness, I think that one thing you might want to say is if you're looking at the yen on a cross basis, it's been behaving pretty well. So if you look at the euro yen, or otherwise affectionately known as the BMW Toyota spread, you'll see that it actually as the yen has been behaving relatively well.
Okay. I mean, listen.
Don't be so enthusiastic, buddy.
No, but listen. The yen was so ravaged.
Yes.
That and you do have the central bank intervening to defend it. So of course you have to believe that if the U.S. dollars can keep ripping, the euro will do worse than the yen.
Yeah, okay, so that's all I'm looking
Congratulations.
for. I'm just trying to find somewhere that doesn't hurt me while the U.S. dollar rips. And I think that the yen's there. Like I think the yen, yes, could it go lower, meaning higher on that USD GPY rate? Yes. Do I think it's going to rip as much as the euro? No. And watch now, I probably goochered it. Okay, so what other charts you got?
Well, just quickly, super fast. Australian dollar, obviously breaking now, pretty much breaking to a lower low. Very weak. They didn't raise as aggressively as everyone was expecting, and it's just punishing the currency. Any comment?
I'm actually bearish. Australia, I'm bearish Canada, I'm bearish Sweden, I'm bearish all the countries that have a housing bubble with too much short-term variable debt with high consumer amount of debt. So even though I'm kind of
going digging.
I'm torn because I like they're like in terms of Australia and Canada, they're both commodity, and we could get a situation where the commodity aspect lifts them up. So I don't know if playing the currency is the best, but I think that there are trades on a fixed income basis on those currencies and the yield curves and things of that nature, because I really think that I don't know about Australia. I got to look more into it, but here in Canada, our housing is collapsed. There's nothing going on. There's no bid. I saw today the unemployment numbers, although they were fine. I saw there was their first signs of kind of iffiness. We weren't as strong as the U.S. And I just look around, Patrick, and it's just housing was such a large component of our economy, and rates have been cranked so high. And I'm hearing anecdotal stories about the amount of people that are finding their mortgages getting cranked, kind of a la the teaser rate loans of the U.S. back in the 2005 and 6 era. It seems like it's happening here in Canada, and I just don't see how our economy does as well as the U.S. on a relative basis. So it's tough for me to say anything except that at the margin, apart from the commodities, neither one of those currencies have anything going for it.
All right. Just quickly, I want to look at two more things. Number one, I want to look at gold. And what's interesting is that gold bounced, but the low of gold came in almost the same day as that short-term dollar peak. And really, gold just has behaved like a cross currency to the US dollar. But gold has actually been doing relatively better versus other cross currencies over the last little run here over the 5-6 trading sessions. It'll be really interesting to see whether gold starts getting a little bit of relative attention. Like, listen, if the dollar goes ripping higher on another full leg, it's possible gold's going to a lower low. By no means is it all upside from here. But I'm just looking to see whether or not maybe I'm just stupidly bullish as always and about to get my face ripped off on it. But I think that there's a chance here that gold just does better.
Well, from your lips to God's ears. And then the final one, crude oil. What are you looking for there?
Well, listen, I've been literally for 2-3 sessions saying how critical it was for oil to beat this kind of $88 to $90 level. There was a fib zone, moving averages, descending trend line, just about every technical
dogs
method
and cats living together.
Exactly. It was nuts. And the thing is that I was like, nobody should be getting excited about an oil reversal until we start clearing that hurdle. And today, with this $4 up day, we cleared the hurdle. And all I want to see is now the bulls buy dips. If we do, then this could have been the turn point in oil. And I don't want to get excited about one day alone, but it's the first legitimately positive price action that we've seen in oil since it's run in the first half of the year. And
you heard it. And I like it. I like it, Patrick.
Right. And all right, that's all I got for today. But
all right, let's go on to
skin in the game, bud.
Oh, it's skin in the game first. You're absolutely right. Okay, now I can't remember what happened last one.
Now I'm confused by this too. It must be some sort of a typo, because here it says that we were talking 10-year T-note futures, and I took under and you took over. It seems like the most bizarre. Like, is my memory failing?
I don't know what that level. It must.
Yes, right? If this wasn't a typo, that means I won. Lena, how many points did I? How many points did I bet
3
on?
points.
Yeah, because you wimped out. Was it another one where I said you bet anywhere from 0 to 10?
I can't remember exactly,
Yeah.
but Kevin, you wanted to make
Yeah,
sure,
well-
even if Pat won, that you were still going to be on top. So it was 3 points.
Oh, that's right, because I was short bonds.
Well,
So
there
does
you
that
go.
now, is
Look
this
at this.
16 to 19?
Who's
is-
It's
caught
up,
now?
is
up
this
to
ref-
date. It's up to date.
Up to date. Oh, so Patrick is he's come from behind. He's put some points on the board. Well,
That's
good for
points
you,
on
buddy.
the board. All I need is one good punt here, and I'm back in the game.
All right, so we haven't talked about it though. In terms of our new bets, are we going to do a 1 week or 2 week? I think we should do a 2 week.
Yeah. No, we got to go to 2 week. We got to go from
Okay.
one
Or else
episode
you guys
to
will
the next.
forget.
Yeah. Well, we're
Yeah.
going to forget it.
We're gonna forget anyway.
All right.
So
What do you got
true.
for me, Patrick?
All right.
Oh, wait, I'm supposed to tell everyone
Okay.
about it though. One
Yeah,
second.
you
Let
do.
me
It's been
go
a
find
while.
this. It has been a while. I'm forgetting the order. I'm forgetting the skin, what to say. Okay, so Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and we play match to 50 points. Basically, the loser is going to take out 3 lucky or unlucky Market Huddle listeners for dinner. And let's just go for it. Patrick, what do you got for me this week?
Well, all right. Let's. I feel like we got to go into one where there's a little bit of skin in the game. I want to go back to that U.S. dollar yen.
Oh, you always do that. So then you
Okay.
make me goocher my trade or take the other side. Okay, so it's 2
Exactly.
weeks.
But
2 weeks from now.
yeah, 2 weeks from now, and and I'm gonna make it a very clean 145 over under. We're slightly above it here, but obviously you got the Bank of
Okay.
Japan on
Yeah.
one
I'm
side
taking
there.
under. I'm taking under, which is what you
Okay,
wanted.
I'll take over.
Okay. Now the real question, because we all knew that that's the way it was going to go there. The real question ends up being, how lucky do each of us feel? Okay. So now we're at 16-19. 3 points would tie you up. 4 would put you in the lead. What do you want to bet, Patrick?
Well, no, you're the one who asked. I made the bet.
Well, I hate to do this to you again, Patrick. 1 to 10, you pick. I'm good for it.
Let's do 4. That way I can jump you.
Okay, there you go. Patrick
We're doing
sets
4
the price
points,
at 4. All right.
4 points. So it's 16-19. So
So you-
if you win, you're going to have once again a very healthy lead, jumping up to 23 points.
And
And
if
and
you win, you'll take the
I
lead for the
manage-
first time, maybe for this whole thing.
yeah, no, actually, I may have had the lead on the very first bet.
okay.
and then you just
Well,
took
good
over.
for you. You
So-
you stayed in there.
Oh, good for me. You stop it. Whatever. Jesus.
Well done, son.
Okay. All right. No stupid questions. Alina, please help us out here. Okay. Go for it, Alina.
Hi, guys. I never missed your show and congratulate you on dragging all of us macro tourists into some basic macro literacy. Every episode contains a delightful mixture of insights and entertainment. Thank you for your work. My question must have a simple answer, but I listen to a lot of the FinTwit podcasts and have never heard the answer. If treasuries trade along a curve which at all points is yielding less than inflation, why do investors accept this negative real yield? Assuming there isn't yield curve control, why doesn't the market sell down treasuries as inflation increases so that the return is always a real positive return?
That's a great question. That is an awesome question. Really, honestly, that is one of the better questions that we've ever had. Okay, I'm going to take a shot at it, Patrick, if that's okay.
Yeah.
There is, there's lots of different reasons, but I would say that the main one is that there are trillions of dollars out there of savings that need to be invested. And this is something my buddy Morris Sachs always reminds me whenever I get too bearish on the bond market. Although the bond market, at last I checked, had a little bit of a tough time this year. He says there's always going to be buyers for this because of the fact that we have all this savings that needs to be invested and they need the safe assets. And it's something that we as civilians don't see because we're not trading with all these people, so we don't see the wall of buying. Now, gets a little more complicated because you could argue and say, well, why would an investor go out the curve and give their money to the government for an extended period of time when they expect inflation to be, let's just say inflation's 2%? Why would you ever give the money to the government at less than 2% for an extended period of time? And the trouble is that if you have periods where inflation dips below and the central bank is going to have it actually setting the money market rate or the Fed funds rate at below 2%, it might make sense to go out and buy duration and go out the curve. But at the end of the day, it ends up being the main reason is that investors have confidence that the Federal Reserve will achieve their target of 2% over the long run. And there's something called term premium, which is in essence the amount of extra that investors will demand to extend a loan, meaning buy a bond, over a longer period. And if you look at the 10-year term premium as measured by the one that the Federal Reserve uses, it's negative. And this is actually one of the conundrums, and one of the reasons I think a lot of people don't answer is that because that really nobody understands why that's negative. It really shouldn't be. It in a lot of ways we should have, if you're giving the money to the government and there's a possibility you're going to have inflation of whatever, like, we just had 10 or 9.5%, and we have a 2-year that's almost 4 or 4 and a 20 or whatever it is, you should be demanding more to extend out like that. And the term premium, though, is negative and stay negative. And I think it has to do with Morris Sachs's wall of money from pensions and all that. And I think it's kind of one of those things that eventually the psychology will change and that term premium will go from negative to positive, and we will see the longer end go up. But in the meantime, we don't. And I think it's just also one last thing. I'm talking a lot, I know. It's been 40 years of the greatest bond bull market up until this last year that we'd ever seen. There's guys like Patrick that were bond investors and had Gary Schilling on their wall because of deflation.
I was taking a sip of beer when you said that, and I literally nearly choked.
And they've been conditioned to expect inflation to come down, and that's why this was such a big secular moment when 2020 hit and COVID changed that forever with fiscal coming back. And so it's a complicated question. I probably didn't do it justice. I kind of wandered. But
they are always complicated.
Yeah,
questions.
There we go. But it's a great question. Great question.
All right.
Lena,
next
second question. Hi, Huddlers. Love your show and have been following for the past years from across the pond. I have a question about the US dollar. What drives the recent rise of the dollar? People going to cash? Everyone said printing money would kill the dollar, but it seems almost an inflation hedge for someone living abroad. I see a strong correlation with interest rates rising, but what are the drivers of the dollar going up or down in this recent period? Talking Dixie or Euro here just to pick a measure. And when would you short? When Powell stops hiking? Thanks, from London.
Wow, this is this is not one that can be answered in a minute or two, does it?
Yeah, but we never do that anyways. By the way, I was just going through, you know how like your computer serves you up things saying from last year or whatever? So whenever I see stuff from my database, I put it onto my computer, and it served me up this thing that was like from last year, and it showed like one pig humping another pig, and it had the listen.
Year.
Yeah. And it was and the Bitcoiners had written Bitcoin and then the US dollar. And I was laughing myself silly. I was thinking how funny it is. It was only a year ago that they thought Bitcoin was the quote unquote inflation hedge and that they were giving it to the US dollar. And it's interesting that this Londoner, this fellow from the UK, views the dollar as an inflation hedge.
Well, I mean, if somebody who's holding U.S. dollars and their cost of living is rising in the UK, they've been able to actually see the value of their currency hold up, right? Like at least it's. But the interesting part is that what everyone has to consider is simply that the U.S. dollar is the world reserve currency, and the supply of dollars is a big factor for global trade. And so there's a dynamic there that makes this a very, very complicated answer. But I mean, you can certainly add some color to it. But ultimately, the U.S. dollar, especially during periods of crisis, has always played a reserve currency where money just flocks when because you don't know what's going wrong where, and because we've seen such weakness in Japan and in Europe and places like this, that really the U.S. dollar and the fact that interest rates are rising faster in the U.S. Is that something you want to add to that?
Yeah. So it's complicated because, as Patrick's mentioned, it's the reserve currency, and it ends up being a little bit of a tail wagging the dog, like which one's causing it or reacting to it. For example, when we see that the U.S. dollar rises, people that have borrowed U.S. dollars, those loans become more expensive, and they therefore will pay them down. Credit will contract as you get, and that feeds upon itself, which raises the price of the dollar, which then causes people to buy more back, and it becomes a feedback loop, which we have seen at different times. We also have right now the Federal Reserve actually purposely doing this to try to fix their inflation problem. If you think about currencies on a general level, what affects it? One, you could get hot money coming in because they're either buying the stock market or buying financial assets, like buying bonds and things of that nature. Or two, they could be actually buying goods. And so the terms of trades will matter. And the trouble is that at different times, different aspects will affect the currency. So at times, the terms of trade will matter. Other times, the currency, the interest rate differential will matter. If you look, for example, at the Canadian dollar, you'll see that it follows the price of deferred crude oil futures and the spread between the U.S. and Canada 2-year. So that kind of explains the two different aspects because we're such a petrocurrency. Trouble is that over the last little while, we haven't moved with the crude oil, and it obviously diverges. And eventually what happens is if it diverges enough, you get these points where it becomes so cheap that people start changing their behavior. And I'll just give one quick example. In 2007 and 8, what happened was that Canada, we had a currency that was or an economy that was generally viewed as better run than the Americans in terms of we didn't have banks that were in trouble. Our real estate wasn't as blown up back then. And meanwhile, U.S. was having trouble. And our currency actually went and became more expensive than the American, the American currency at the time. And I can tell you that almost every douchebag on Bay Street, which is our equivalent of Wall Street, bought themselves a Florida place. And so what you see is it eventually hits a point where it made such sense. Things were so cheap that it made sense for them to actually go and invest large sums of money because it was just too cheap. And I would argue that Japan, Europe, a lot of these countries are approaching those levels, and you're going to start to see people doing that. I know I've gone and looked at just even going on vacation. You're better off, like as a Torontonian, flying to Portugal than you are flying to Florida.
Wow.
Anyways, number 3.
All right.
Hi, Kev, Patrick, and Lena. I have a good friend who day trades ES. He's indoctrinated with the belief that he can become consistently profitable at a scale that replaces his engineering income. But between all the hacks shilling $200 a month memberships and the FinTwit teens humble bragging in front of someone else's Lambo, I can't shake the idea that the whole day trading world is a giant scam. So, is day trading a retail pipe dream? Is it possible even if it's absurdly difficult? If my buddy's drinking Kool-Aid, I want to let him down easy. # save my friend.
All right, I'll start and then.
Okay.
Oh yeah, you could add to it, but I would say that day trading is the true gladiator sport, and it's where the strongest survive, and there's a lot of people that are thrown in there as fodder. Ultimately, there are people that successfully do it. There are people there that make a living on it. But it is an incredibly challenging endeavor because the amount of discipline, the amount of attention that has to be put in, you have to hone your skills so much to make it happen. And I did it for almost a decade, and I found that I uh, trade better over longer periods of time. And I find that trying to clip little sums of money out of the market is a lot of work for a small payoff. I've sort of gone a different direction personally. But there are people that do it successfully. It's just it's a tough game.
So I will echo Patrick's general view that it is an extremely difficult game. And I can't remember what the number is. Like futures accounts, I can't remember. 95% of futures traders lose money. Retail futures traders lose money. It is something that is very, very difficult. But if you have the ability to stick with it and learn it, I definitely believe that someone with the right discipline and the right emotional makeup can make lots of money doing it. And I think it's probably one of the few areas that somebody that is the right mindset and has the right financial kind of wherewithal to manage to get to that point. It's really, truly one of the unique opportunities out there. But this is the advice I would give is expect to lose and expect to lose for a long time. So let's say this fellow is an engineer. He's got no family and he saved himself enough that he can live for 3 years without having to go get a job and be able to spend 3 years learning how to do it. Then I would say, great, give it a whirl as long as you understand the risks that you, at the end of it, you'll have to go back to work as an engineer. Having said that, if someone said, well, you know what, like I'm quitting, I got 2 kids, I really need the money, I got a big mortgage, I would say there's not a chance they're going to make it. 0. Because you're going to lose. It's going to be some up and down. Go back and listen to all the stories of everyone that made it from the pits. And I think the pits are a perfect example of kind of what you're looking for when you think about those people came and everyone wanted to be a trader, everyone wanted to do it. And the reality is that 9 out of 10 of them left. So they would go, they would try, they'd blow up and they'd be gone. It was just life in the pits. That's how it worked.
And even if you end up being successful, there's a huge emotional learning curve that you get chewed up and you get taken through so many emotional roller coasters that if you survive it, you're a true veteran, right?
Yeah,
it's
I think you can, with the right mindset going in and viewing it as a business, I think you could probably train someone to do that, but it's tough. And I don't think the other thing is that in terms of day trading, yes, you can go learn and you should go take the courses and find somebody you like that gives you some community and able to talk to other day traders. But ultimately, nothing's going to, you're going to have to make the mistakes yourself. And that's the point that everyone needs to realize. And you need to have the financial ability to go for a long time without making money. And that is the key. That is the most important part of that. So if your buddy can, he can stand 2 years and not making any money, go for it. If your buddy is going to tap out after 2 months, if he doesn't make money, then not a chance. I would stick to engineering. That'd be my advice.
Lena, last question.
Last question. Why can't a central bank raise interest rates and buy bonds at the same time? They don't care about their P&L, right? And isn't this a good way of curbing private consumption to lower inflation while supporting long-term government programs, i.e. giving the government fiscal space to subsidize power plants or LNG terminals?
So you want me to take this one, Patrick?
Yes, but I'll just quickly say one thing in here, right? I mean, them controlling interest rates at the front of the curve is Fed funds rate, which is something that all central banks can control. But when doing something like yield curve control, that involves the buying or selling of bonds farther out to change the shape of the curve. And so, correct me if I'm wrong, but you can have banks raising short-term interest rates and at the same time buying bonds is possible, and if they're trying to shape a curve a certain way. But they don't set longer-term interest rates.
So yes. So I'm going to talk about the plumbing. This is a great question because The Federal Reserve believes you shouldn't do it. I think they understand they can do it, but they shouldn't do it. And this goes back to one of the big complaints people had with Powell in terms of him taking his time starting this latest rate hiking campaign. If you remember back, they had announced their tapering of the QE, and they still had a couple of months where they were going to taper. They were still buying bonds, doing QE, and therefore he argued that you could not raise rates while you were buying bonds. From a plumbing perspective, like from like how the markets actually work, complete bullshit. The Federal Reserve could have done that. And in fact, we might see a situation where the Bank of England's doing that. We might see them raising rates while they're doing QE at the long end. It doesn't actually, there's nothing stopping them from doing that. In the old days, before we had interest rate floors, interest on excess reserves, and in the old days when the Federal Reserve and other central banks would manage interest rates by buying and selling reserves, we couldn't do that. But in the modern post-Great Financial Crisis era, they're able to do that. They believe they shouldn't. They believe they shouldn't be doing, in essence, a policy that is both expansionary, which they believe QE is expansionary, and contractionary, which is the raising of rates at the same time. They also believe that would, to what this listener was mentioning, that they would be venturing into the realm of financing government deficits, which they argue that they're not doing. So it's a lot of political reasons. The long and short of it is that there's no plumbing reason from the way that the markets work that they couldn't do that.
Perfect. All right, Lena, where can people submit questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Okay, I got a little bit of a rant to do before we finish up.
All right,
okay.
Go for it.
Patrick's like, oh, shit, here we go again. Okay, so I just want to say that times are tough out there, and there's no doubt about it. I've seen a lot of people that are having a lot of struggling and having difficulty. In fact, I was out with one of the smartest traders I know the other day, and he told me, he said, I'm struggling this second half of the year, which is a real pisser because I actually even called everything correct. So it seems like fuses are short, and I'm seeing more and more people ripping into each other about markets. Okay, it reminds me a lot of Bob Farrell, the legendary Merrill Lynch strategist, his 10th rule, which is bull markets are more fun than bear markets. And I was like, I didn't really used to understand that one, and now I think I get it. Okay, but I want to remind everyone, okay, and I'm going to get a little bit of Twitter wisdom here for you folks, and I'm going to quote this. We are all literally sacks of meat floating around on a rock in space. Okay, not one of us is better than anyone else. Just remember that. And the thing that I just really bothers me about the people fighting about markets is it's all bullshit. Do you think it means anything that you were right about your asset XYZ that you called from 2 years ago? Unless you made money on it, it means squat. And I got a quick story to tell you about this because this demonstrates the difference in thinking that occurs out there. Okay, when I started my career on the sell side, I worked at a brokerage firm, and they were originally a partnership, and they were privately owned or owned by the employees, and it was eventually sold by the bank. And the bank eventually, what happened was the brokerage took over the bank. And one of my bosses went, and he got given the Latin American division research thing. And he went and asked them, okay, he's learning about it. And he's saying, well, what do you guys do? And why do you exist? And they told him how they had correctly forecasted that this, whatever the recent crisis was in whatever Latin American country that they were studying. And then they explained to him how, because of their efforts, the bank had only lost $500,000. My boss is like, what the fuck? It was like they were putting mayonnaise on a peanut butter sandwich. He says, you guys predicted this crisis, and instead of profiting from it, you lost $500. Okay. And that's what it feels to me like with a lot of people that are arguing out there. Okay. It doesn't mean shit if you aren't making money. And then if you are making money, let's just say you are the people on the other side that are doing well, what the hell do you care if someone has a different opinion? Okay, hit their bid or take their offer without bothering trying to convince them that they're wrong. Okay, do you think Stanley Druckenmiller tries to convince you or me that his opinion is the correct one? And in fact, he's the first one to tell you he's wrong all the time. The world would be a pretty boring place if everyone had the same opinion. And to top it off, there would be absolutely nobody to trade with. So instead of getting mad at others' opinions, be happy they exist to provide you the liquidity. And for those who are feeling chuffed with themselves for their great calls, be humble. Your bank account should be reward enough. No need to shit all over your fellow humans. Now, sure, some of them deserve it. Anyone who rubbed it in their face about this whole have fun staying poor shit showed little understanding how hard this game is over the long run. But they're likely now struggling from their financial decisions. And if they aren't struggling now, then that's good for them too. I don't care. I'm not trying to punish those people that did have fun staying poor. I hope they sold at the top. I doubt it, but I hope they sold at the top. Life is way too short and tough enough without us attacking each other for market views. At the end of the day, we're all just lucky to play this big trading investing game, and it's all just noise compared to the other important things in life. When my daughter was young, I used to go to the hospital for sick kids in Toronto, and I would see kids that were truly dealt a terrible hand in life. Kids that were struggling with cancer and had weeks to live, and yet they were kind and smiled in the face of the unjust position they were put in. And then just remember, even with all the money in the world, it doesn't mean anything without your health. Look at Steve Jobs or Gord Downey, who were both taken away from us with cancer. If they were traders, do you think either one of them would have cared that somebody disagreed with them about the likely path of the US dollar? So there's nothing wrong with having different opinions. Heck, that's what the Market Huddle is all about. Patrick and I disagree all the time, and we don't. It's a value-added fade from us Canadian mopes. But let's remember that we're all human. Let's be kind and remember what's truly important in life. And trust me, it's not your US dollar theory or your S&P 500 call. Rant over. I'm just sick of everyone being so mean. It just bothers me, and I see it. I'm just like, fuck, guys. It's not like we're curing cancer here. No, I
have to agree with you, buddy.
You know what? And maybe I didn't articulate it well, but I'm so fed up of everybody being so mean. If you got your call right, great. Be humble. And if you got your call wrong, then just keep your chin up and hope that those assholes rubbing it in are going to go away. But anyways, I just think we should all be more kind. Okay.
Well, listen, I can't disagree with you. That's I love doing the show with you, but it's the markets. I just love talking them. I love sharing it, and everyone has different opinions, and we just roll with it.
Yeah. And that's what makes it so much fun. Anyway, so rant over. Enough philosophizing for this idiot. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're on Twitter every day. Give Lena a shout out. She gets tired of talking to Patrick and I. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, YouTube, blah, 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 blah. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. Patrick, where can they find you?
You can follow me at bigpicturetrading.com or on Twitter at Patrick Seresnik. Where can they find you, Kev?
Patrick, you're kind of like Where's Waldo, by the way. Where can they find? We're going to have a Where's Patrick. You can check me out on Twitter at Kevin Muir, or you can follow my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show. Okay, Patrick, give us the rating of the Moroccan beer.
Well, you know what? I like it. It's a good beer. It's look, I wouldn't say this is an extraordinary awesome beer, but listen, anyone that wants to try a good beer when you're out here in Morocco for whatever reason, pick it up. All right, I'm gonna give it I feel so amateur doing this, but I'm gonna give it a 7.7.
That's not an amateur score. That's fine.
No.
Okay.
Anyway, so what do you want to talk about?
I guess, well, first of all, I want to give a big thank you to my hosts in New York City, the main one that I went down there for. And he talked about it on his show, so I feel like I have the freedom to talk about some things, although Chatham House rules do apply, and I won't name people. I'll let him name people. But I went to see Morris Sachs, and I had just a wonderful evening. It was great to meet him in person. He's every bit as charming and wonderful, and I hope he feels like, you know, when they say you shouldn't meet your idols, Morris is definitely not one of those fellows, and I hope I didn't disappoint. It was a little difficult. I was in a group of tight guys that had been together for a long time, and I got to listen to their stories and have a wonderful steak, and it was a terrific time. So I'm really super appreciative of it.
Did you guys go biking after?
No, we did not go biking after. I went. Morris went home. He had a long drive back to the Greenwich. I did go. I met. I went with. I guess I can say the currency trader, and I went with Liam and my new favorite Swiss / hedge fund manager, who's really Irish. Although he did have an advantage because you know me with the Irish. It's like the Brazilians. Irish and Brazilian. Like, I'm like, they're the nicest people in the world. I've yet to meet a bad one. I don't think there are bad ones, in fact. They're like the most lovely people. Both of them. And he was super smart. I was like, oh my God, I got to go think about that. Oh my God. Anyways, he's a terrific guy. Had a terrific time. Then I got to meet some other wonderful Macro Tours subscribers. Thank you for everyone that had me come by. I really appreciate it. It was fun going out for dinner with my new real estate pal. I did meet a Brazilian, by the way, who flew in and he hadn't slept. He had taken the overnight and his flight had literally got sent home, and he still came out drinking with me at like Saturday at 2.
Wow.
I was like, oh my God, you guys are crazy. And then I went to the final evening. I don't know how much I can say here. So it was sponsored by CC Capital, but don't look it up because it's not a real thing. And it was a group of degenerates. I think they would appreciate them being called that. And that was a great evening. I didn't go as hard there because I had to have, I got a plane the next morning at 6. But I did notice that one of those degenerates was on a 6 a.m. flight and was tweeting out burger pictures at 4 a.m. So I'm just a fucking lightweight, I guess.
That's the conclusion of the trip.
Yeah.
Oh, there you go.
So it's fun. But listen, I do have, new topic though. Thanks again to everyone, and especially thank you for Morris for hosting and picking up that dinner. It was truly wonderful, and it definitely meant a lot. The one thing I do have a recommendation, Lena, and I think you'll like this. Patrick, even you might like this. It's a podcast. Since you're traveling around so much, you might appreciate it for the plane ride. It's my new favorite thing. I'm addicted to it. I think I've just, like, you know how Lena used to say you finished the Netflix? Yeah. I think I've just listened to the whole thing. It's called My Therapist Ghosted Me. Two Irish young lasses. They're like 35. One's a model, one's a comedian. And they are the funniest things I've ever heard in my life. I'm busting a gut. They talk about everything and anything, and they do it in their accents. I'm trying to figure out half the words. I am saying Kraken a lot more. That's Kraken. I think I'm using that correctly. It's not spelt the way we spell it, though. It's like CRAIC. That's crack. I think you're supposed to say that. Anyways, I'll get it eventually.
Send me WhatsApp me the link.
I will. It is literally the funniest thing. You got to listen to it. They are a hoot. And they just make me laugh over and over again. I want our show, Patrick, to be like as loose. Well, no, that would be a little too loose. Wait till people will be like, "Oh, this is what he aspires to." I'm like, "Oh no." Anyways, it is funny. They call when someone's good looking. Lena, you'll like this. If there's a good looking guy, he's a ride, and that is how you think it is. And they give each other shit all the time, or they're making fun of each other. You're gonna go home and paw it yourself, aren't you? Which
oh my goodness!
Yeah, they are the most fun, and proving again, the Irish and the Brazilians, nicest people in the world. So there you go. Lena, do you have any good shows?
No, I've been watching the Grand Tour.
Oh, like the old one?
I guess it's
Like-
like from 2016 or whatever. I
Yeah,
just
yeah,
finished
yeah. Oh.
season 2.
It's good, eh?
hilarious. Yeah, it was.
Yeah, no, it's
Every
good.
time I watch
like
it, I would go, "Boys will be boys."
Yeah, no, well, they're a special brand of idiots that are boys, like, but they sure make an entertaining show about it.
It's middle-aged boys
Yeah,
with lots of money.
With money, like just
and
doing
fancy
stupid
cars,
shit.
but it's very entertaining.
Did you ever watch him with the farm one he did?
Yeah.
'Cause I think the farm one was even better
No,
than
the
the
farm
car
one is
one.
great. Jeremy
Yeah.
Clarkson's Farm or whatever it's called.
Yeah.
Yeah, that one's
But
great.
I didn't realize you hadn't watched the Grand Tour. No, I liked it a lot. I thought it was really good.
I was kind
I
of
wish
holding
they-
off on it for a bit because I wanted to.
You were saving it.
Yeah. So that's what I watched now.
Well,
So-
I'm surprised you haven't been all over this Dahmer thing.
I started first episode.
Oh, were you disturbed enough to stop?
No, I knew the story. Like I know the
No,
story.
but you know, supposedly one of the guys on the desk told me that he cuts up a heart and fries it, and you hear like the frying sounds.
I mean, that's expected if that's what's gonna happen. But
Well, I don't know. I'm not quite ready for that. A lot of guys seem to tap out on that. I'm unsure about how I feel about it.
well,
like when you actually
it was
hear
a
the
bit
frying.
of a slow burn. So
Is it?
like the first episode, I was like, the people that I was watching it with, they were like, "Nope, can't do it," and I was like, "All right, well, I'm okay to just not watch right now, but I'll probably watch it when nobody's home, when I want to fall asleep."
There we go. That's Lena for you, folks. I'm gonna watch a show about a serial killer that eats people to go to sleep.
It's a woman thing, I think.
I know. I don't really get it. I don't understand your fascination with
I
it
think
because
part of it is psychologically we're always looking out for danger, like when we're
right,
out.
because we can kill you theoretically. Because we're
so
yeah.
I think that's where we have
But-
a fascination. We're like, oh my gosh, like if that would ever happen, what would how
I'm
would
a
I
5'9" fat guy. Like a lot of guys could kill me too. Like I'm not that hard. Okay, I'm getting the
There you
boot
go.
at home here, so I better
Hey.
call it a night because
No,
actually.
well, do you know what I'm doing tomorrow?
Oh
Or on the
no!
weekend?
Go ahead, Patrick. I'm sorry, I didn't realize you were. actually-
No, I'm gonna go on a 6-hour camel ride into the Sahara Desert and camp out in the middle of the
I
desert.
hope you pack sunscreen.
Seriously?
Yeah,
One hump or two?
I don't know. I haven't seen the camel yet.
Okay, this is
I'll
very
let you-
important. I want to know one hump or two, and if you have stuff, I really want to tweet and make sure you tag me on it so I see it.
Show us your
Oh
tan
no,
lines.
I'm not.
And I want to know the name of your camel too. And I want you to be good to him because like I suspect that he gets a lot of like fat like Western people. And he's like, God damn it, another fatto, like Western. Now
I'm gonna give him some of my rum.
Yeah.
I'm gonna give him some of my rum.
Okay, and then you're going out for 6 hours. And you're not sleeping out there though.
No, sleeping out there.
You
No,
are.
No. You're riding out for 6 hours to get there.
Oh my gosh, that's adventurous.
I hope they wait for you to wake up in the morning.
Yeah, and I all of my shit got lost in the luggage that I don't have. So I literally have bought a bunch of these Moroccan clothes.
Go buy
here.
yourself.
Blend in with the locals.
I'm blending in with the locals.
You just need a Speedo. That's what I'm looking
Oh my
for.
gosh.
You want a Speedo
Oh my
on
gosh.
the camel.
Oh gosh.
No,
Okay.
Oh,
no.
bad
Patrick.
visual.
All right,
Stay safe, buddy.
all right. Have a great weekend, guys.
Okay, take care. Bye-bye.
All right, cheers, everyone.